Why your timeframes are confusing you. One big wave is actually made of 5 smaller waves, and a correction breaks down into 3. Cycles exist within smaller cycles.
That feeling when you're looking at your time frames and they're just confusing you? Well, welcome to day 7. This is the grand finale of week 1 in our Time and Cycle Mastery series. If you've ever stared at a chart and felt completely paralyzed because the market is just throwing drastically mixed signals at you across different time windows, well, today's the day we fix that. We're going to unlock the secrets of market geometry and finally map out the hidden order hiding right there beneath all the chaos. Let's dive right into this explainer. Okay, so today we're going from that initial pull-your-hair-out confusion of contradictory charts all the way down to mastering the tiny subdivisions of price action. Here's our game plan. First, why timeframes confuse you. 2, the fractal nature of markets. 3, the 8-wave cycle. 4, waves within waves. And 5, avoiding analysis paralysis. Let's get to it. All right, kicking things off with section 1, why timeframes confuse you. This is a super real, visceral problem that plagues almost every single trader.
So why exactly are your time frames confusing you? I mean, picture this, right? You're sitting at your desk, maybe sweating a little bit, hovering right over that buy button. You pull up your daily chart and boom, it's showing a roaring, undeniable bull market. Looks like a total rocket ship. But then you toggle over to your hourly chart and it is just screaming that a vicious bear market has started. It feels completely contradictory. You start panicking, thinking, wait, which chart is lying to me? Is one of these a trap? But the crazy truth is, neither of them is lying.
The really crucial thing to wrap your head around here is that markets exist in continuous time. They're influenced by multiple cycles working all at once, 24/7, 365 days a year. Think of it kind of like the ocean. Your daily chart, that's the massive, powerful tide steadily rolling in. But the hourly chart, those are the smaller, chalky waves violently crashing and receding right there on the beach. They might twist, distort, or seem to pull you in the total opposite direction for a minute, but they haven't vanished. They're just combining with those longer, deeper cycles to create the actual trends you're seeing. To actually solve this time frame confusion, we need a complete paradigm shift in how we view every tick of price movement. So let's jump into section 2, the fractal nature of markets. Okay, so markets move in a fractal pattern. Basically, this is a wave within a wave. Think of market movements literally like those Russian matryoshka nesting dolls. You have this big, sweeping macro move, and if you open it up, it contains smaller moves. Open those up, even smaller moves. In trading, we call these different layers wave degrees. It's a structure where the market moves in repetitive cycles. This means the exact same mathematical patterns playing out on a massive multi-year monthly chart are actually happening right now, this very second, on a tiny 1-minute chart. And this brilliantly illustrates the hidden engine of the market. What looks like total, utter chaos to a beginner is actually this beautifully synchronized symphony of overlapping cycles. Just look at how multiple cycles, like the green and pink waves, combine their invisible influence to create that messy, dark blue price line. Notice how the absolute bottom points of the green and pink cycles are synchronized in perfect harmony, but their peaks, totally displaced. That hidden interaction is the actual engine driving that chaotic-looking blue price line. Now, let's get into the mechanics of how this rhythmic engine builds into the standard Elliott Wave cycle. Section 3, the 8-wave cycle. According to Elliott Wave principles, a complete market cycle consists of exactly 8 waves. That's 5 pushing the trend forward and 3 pulling it back. But honestly, it's the psychology behind this that's so fascinating. First, you have impulse waves. These are 5-wave structures moving with the primary trend, and they are largely driven by a slow, powerful build of market optimism, greed, and, you guessed it, FOMO. Then you have corrective waves. These are 3-wave structures moving violently against that trend. And these are usually driven by the sharp, sudden collective realization of fear and uncertainty. Check out the visual rhythm of the impulse wave playing out here. Look at how waves 1, 3, and 5 push aggressively upward. They're violently moving in the direction of the dominant trend. Meanwhile, waves 2 and 4, those act as minor corrections. They're basically the anxious little breathers the market takes along the way. It's really just a rhythmic, forward-marching staircase fueled entirely by human emotion. Now, huge warning here. You cannot just guess these patterns or force the market to fit some narrative you scribbled on the screen. You absolutely must adhere to the unbreakable laws of market physics, or your wave count is just totally invalid. The creator of this theory, Ralph Nelson Elliott, was actually a professional accountant. He was completely obsessed with finding strict mathematical order inside the stock market, and his rules are absolute. Rule 1, wave 3 is never the shortest wave of the impulse. Rule 2, wave 4 cannot overlap into the price area of wave 1. And Rule 3, waves 2 and 4 must display alternation. Basically, if wave 2 is a simple sharp pullback, you should absolutely expect wave 4 to be a complex, drawn-out sideways consolidation. All right, so following that powerful greed-driven 5-wave impulse, the market has to retrace in a fear-driven 3-wave corrective structure. We label these A, B, and C. These corrections often form distinct shapes, stuff like zigzags, flats, or triangles, before the primary trend is finally ready to resume its forward march. And this is exactly why this matters so much for you. This ABC phase is precisely where impatient traders get chopped up. They lose their shirts in sideways zigzags because they mistakenly believe the entire macro trend has reversed. It hasn't. Let's zoom in even closer and uncover the real fractal magic that causes all that time frame confusion we talked about earlier. Section 4, waves within waves. Take a really close look at this, because it's kind of a revelation. Notice how the simple 5-wave structure on the right is actually made up of the highly subdivided waves on the left. That larger wave 3 literally contains its very own mini 5-wave impulse inside it. This is exactly why your time frames conflict. Your hourly chart might be experiencing a terrifying, sharp corrective wave 2 downward, making you think the sky is falling, while your daily chart is still just comfortably riding a massive, overarching wave 3 upward. The macro move contains the micro move. To measure these inner fractals accurately, the pros use Fibonacci relationships. Now, if you're not familiar, Fibonacci is a mathematical sequence that dictates the geometry of nature. We're talking everything from seashell spirals and entire galaxies all the way down to the predictable swings of human crowd psychology in the markets. By applying this math, traders pinpoint the exact depth of these matryoshka doll pullbacks. For example, wave 2 typically retraces 50 to 61.8% of wave 1. Wave 4 is usually way shallower, pulling back around just 38.2% of wave 4. And that powerful, trend-defining wave 3, it often extends a massive 161.8% of wave 1. Adding these Fibonacci levels turns what used to be a subjective guessing game into a highly objective mathematical trading map. As we zoom back out to wrap up week 1, we really need to address the absolute most dangerous trap in fractal trading. Section 5, avoiding analysis paralysis. This quote right here is a massive, critical warning. Too many traders get E-wave paralysis of analysis when they try to put E-wave labels on every little section and lose sight of the bigger picture. Look, when you realize the market is completely fractal, it is incredibly tempting to try and label every single 1-minute twitch on your chart. But doing that, it will completely freeze your decision-making. You end up with a chart that looks like a Jackson Pollock painting, just an abstract canvas covered in 100 tiny numbers and letters. You stop being a reactive, profitable trader, and you just become a paralyzed academic analyst stuck in the noise. Context is king, right? But too much context is basically quicksand. By strictly limiting yourself to a maximum of 3 wave degrees or time frames, let's say the short, medium, and long term, you maintain absolute clarity. You get all the context you actually need to understand exactly where you are in the trend. And that allows you to build a specific, actionable, and confident trade strategy without drowning in all that microscopic noise. So this brings us to our final thought. Are you going to keep fighting the chaos of conflicting timeframes? Or are you ready to use the fractal engine to find the hidden order in your next trade? That officially wraps up day 7 and the grand finale of week 1 in our Time and Cycle Mastery series. Take these fractal rules, draw out those wave degrees, apply your Fibonacci tools, and just see what the market truly reveals to you today. Keep learning, keep charting, and I'll see you in the next explainer.